So today, before we get started with, by moving forward with the material, I want to go back and take up one more example, one more application of this loanable funds model that I forgot to cover before. What we want to talk about is this, the business cycle and interest rates. Business cycle, let me write this down. And we can kind of summarize this in GDP, okay? And by GDP, real economic activity. And what happens over time is, over time the economy grows about 3% a year on average. But there are times of economic expansion and then there are times of contraction, right? This is a period of expansion. What do we call this period when the economy is contracting? A recession. So what I want to do is talk just very briefly about how that economic business cycle would affect interest rates. The important curves that we want to talk about is what's going to happen with the business sector and what's going to happen with the household sector. This period of economic expansion, let's consider that first. A period of economic expansion, two things are happening. One is this, employment's going up, jobs are going up, incomes are going up, right? But the other thing is people are becoming optimistic, right? And so during this period of economic growth and rising incomes and optimism, let's talk about the household sector first, okay? Put yourself in this position. Let's say that your employer says, I want you to work some overtime. You've been working 40 hours, now they want you to work 45 hours. Your income goes up. Do you save more or less? More, right? Your income goes up. You'll spend more, but you'll save more. And so this curve shifts to the right. Saving, number 2. Let's suppose that you own a business. Okay? And so now the economy is growing, and you're feeling like, hey, we're selling stuff. Good times ahead. Profits are rising. You feel like investing more? Growing your plant and equipment and you know, like building a larger factory, getting some more delivery trucks and things like that? Yeah. So, D, business investment, number 2. So economic expansion, we see more saving. Economic expansion, we see more borrowing for the purpose of investment. So when we come over and look at the demand for credit, there's a greater demand for credit. When we look at the supply of credit, there's a greater supply of credit. What's the impact on interest rates? A greater demand for credit is driving up the price. A greater supply of credit is driving down the price. Look at the way I've drawn this. I drew it so that there's no change in the interest rate. Well, in reality, that's not going to happen. It's possible that that would happen, but in reality, we can't really count on these two shifts being exactly the same amount. In reality, one or the other of these curves is going to dominate, right? One of the curves is going to shift more than the other. And, by the way, it would all be the opposite. During an economic recession or contraction, businesses borrow less. They say, this is not a good time to invest in plant and equipment. I'm not going to do that. And during a time of people being laid off and so forth, people don't have the income to save. They're spending out of their savings. They save less. And so it's all reversed at a time of economic decline. So we won't get into, you know, the other half of this because it's the same kind of story. Then both curves would be shifting to the left and we'd be over here someplace, right? So anyway, let's come back to this. Economic expansion, greater demand for credit, greater supply of credit. There is no answer to this that we can answer it with theory. That is to say, if we just look at the theory, greater demand, price of credit goes up, greater supply, price of credit goes down. The theory just says, I don't know what's going to happen to the price of credit. If we go back and measure and see what happens over time in reality, and we measure it time after time after time when the economy expands or contracts, what we notice is that business borrowing to invest in plant and equipment varies more, either increase or decrease at a time of recession. This varies more than the shift in that saving curve. And so what will happen is this, I'm going to erase, there will be a greater supply of credit at a time of economic expansion, but the greater supply of credit is minor. And I'll put an S2 here, where that there's a little bit of a greater supply of credit, but there's a much greater demand for credit, so the net impact is for interest rates to go up at a time of economic expansion. And then at a time of recession, there's a big decrease in demand for credit. There's a small decrease in the supply of credit or saving. And so then at a time of economic recession, the big decrease in demand for credit dominates and interest rates go down. There's a term, and then we'll finish this up. We say that interest rates are pro-cyclical. Pro-cyclical means they move in the same direction as the business cycle. When the business cycle is headed up, when the economy is strengthening, interest rates go up. When the economy is weakening, interest rates go down. Okay? And as I say, this is not a theoretical proposition. It could be exactly the opposite. This is an empirical proposition. This is what we observe. And that's where these conclusions come from. The theory just says it could be either way. Interest rates could be pro-cyclical or counter-cyclical. They could go in the opposite direction of the cycle. But we've seen enough of these business cycles and movements in interest rates that we know that they're pro-cyclical, that this shift in the demand for credit is the dominant. Okay? Questions about this?
Did you say counter-cyclical is during a recession?
No. I say they are pro-cyclical. In theory, they could be pro or counter-cyclical. But counter-cyclical would be the economy gets stronger, interest rates go down. And the economy gets weaker, interest rates go up. That would be counter-cyclical. We don't see that. We see here that the economy is in a recession, the economy is going down, interest rates down. So they are still working in the same direction. Up together, down together. Okay? So there will be a point, 1 or 2 or 3 or 5 or 12 or 15 years down the road, and you'll be kind of thinking about, hey, what are interest rates going to be doing? Part of the answer to that is, what's the economy doing? Is the economy getting stronger or is the economy getting weaker? And almost always when the economy is getting stronger, interest rates are going up. Part of the reason for that is the inflation story. I don't have inflation in here, but also when the economy is strengthening, then very often we get a little bit of inflation mixed in. And if you mix the inflation in with this, there's a bigger, during a strong economy, there's another reason for demand to go up, right, if there's inflation. And that will further increase interest rates. But just the strengthening of the economy without any inflation mixed in, we get pro-cyclical interest rates. Okay, let me erase and then we'll go on with what we were going to talk about. Okay. Interest rate on a specific loan is a combination of two things. One is, it's this interest rate from the general environment in credit markets. And we were just talking about that supply and demand. Plus or minus, we have these things called interest rate differentials. And these relate to specific characteristics of a loan. Okay, and what I talked about last time is there are loans that are short-term and long-term. There are car loans, there are home loans, there are personal loans. Each loan's a little bit different. There are riskier loans, there are safer loans. There are some loans that have tax exemption. The interest does. If you lend the money and you get interest, you don't have to pay income tax on it. Other loans, you lend the money, you get interest, you pay income tax on your interest income. So there are all kinds of reasons for these differentials to arise. Okay? Let's talk about the first one, credit risk. Okay, you've undoubtedly heard about some of these credit ratings. First of all, I guess before I get too far into this, credit risk, another term for this is default risk. And now we're talking about the risk that the borrower does not live up to the terms of the agreement. Okay? Credit risk or default risk. A default basically says this: we've got a loan agreement, it's a contract. We signed a contract that says I give you money, it says that you pay the money back under certain conditions. If we know that if I default, when that happens on the first day, I don't hand the money over to you. If I hand that money over to you, I did my part. And so now the question is, do you pay it back under terms that you promised? And that, whatever the terms are, and there can be a lot of terms there, that determines whether you default or not. If you say that you'll give me a payment on the first day of the month and you give it on the second, in theory, you've defaulted on that loan. In theory, there's usually some kind of a leeway built into these things. Right? There is the repayment of the principal amount of the loan, the amount loaned, but then there's also payment of interest. If you don't pay that interest on time, you defaulted on the loan. There are collateral sometimes, some terms for collateral that, oh, I'll loan you the money, but you have to, and then I may have some terms there like, okay, you hand me over the title to your home or to your car. You hand me the mortgage, put my name on the mortgage of your home, and that way, or on the deed I should say, and that way you can't sell that house without getting my approval. Anyway, there are terms for collateral, and then if you don't live up to those terms, you defaulted on the loan. What happens if a loan's defaulted on? Here's the deal. I loan you the money, you make promises to pay me back. If I fall short or you do, but like I say, if I fall short, I didn't hand you the money. If you fall short on paying that back, at the moment that you fall short, you've defaulted, and then the loan is due. We no longer have a deal. Hand it over. And you might say, hey, that's unfair. And I would say, well, I did my part. You asked me for $100,000, I gave it to you. What if you said, oh, loan me $100,000, I'll pay you back under these terms, and I only gave you $80,000. Would you think I treated you fairly? No. So, if you make a promise, you'll pay back on the first of the month, you'll pay interest, you'll keep collateral and so forth, or hand me collateral, and you don't, it may feel unfair that, I say you defaulted, give me my money back, but it's the same thing as if I just said, I'll loan you $100,000 and only hand you over 80. Then you'd just say, hey, you crook. I think that's what you'd say. Anyway, when we start talking about these risks, default risk or credit risk, we have these agencies that rate the risk, okay? There are different agencies. They have a similar but slightly different I kind of get lost in all this stuff. The D, by the way, means default. There are other credit reporting agencies. These usually apply to corporate or government debt. Like if you're loaning money to General Electric or General Motors or General Mills or General Foods or whoever the general is, you can go and investigate the riskiness of lending money to them by reading a publication, or you can go online and find out information about this. Okay. For people, credit score. Okay, and there are different credit scoring agencies out there that give different credit score. My credit score, for example, 300. I'm working it up over the years. Right? Anyway, it goes from, I don't know the lowest possible number, but it ranges from a very small number to a pretty big number. What's the biggest number you can get? Is it 840 or something like this? 850? Mine's, pardon me?
I thought it was 350 to 850.
There you go. 350 to 850? Mine's 350. It's on the rise, though. It's got, you know what I mean, it's got an arrow up. And so anyway, and as we move along from the 350 to the 850, then what's happening is these are safer loans. AAA is safer, right? They both have AAAs, but then after that, they're different. Well, I'm sorry, there's A, double A. Capital letters, lowercase letters. It's customary to draw sort of a line of demarcation. To the left, we have these pretty low risk loans. And by the way, the same idea applies not only to loans, but to bonds issued by these corporations. And governments, like the university or the city government or the county government or the state government, they all have these credit scores, credit ratings. Okay, and so anyway, these are investment grade loans or bonds that maintain these ratings. And below that, what do we call them? Does anybody know? You know the informal term? Junk. And all junk means is higher risk. Okay. Now, let me just mention one thing before we go on. There's kind of a flaw in this whole system. And the flaw in the system is this. Let's just say I run a company and I say, I'm getting ready to sell this bond. Okay, here it is. Here's $1,000 bonds I'm going to sell. They've got a 5% coupon and then, I don't know, a 20-year maturity. And so I'm just getting ready to sell these, but you know what's going to happen is the people who are out here that are potential investors, they want to know what kind of a credit rating does this bond carry? Is it AAA, AA, whatever? What is it? And of course, we've got these organizations that rate those. But do you think these organizations just take an interest in this? I'm issuing a bond, and they just say, oh, Tom's issuing a bond. Let's go out and look that over. Do you think that's how it works? Because that's not how it works. How it works is this. Usually not I. Usually I've retained an expert to help me issue these bonds. But what will happen is either I or my agent will call up these agencies and say, hey, I want you to rate this bond. And they will say something like, okay, that will be, and they've got a fee structure, that will be $50,000, and then we'll rate your bond. And so then here I am, I'm borrowing the money from investors over here, and I'm selling the bond, and now I'm the one paying them. If they were getting their payment from those investors, then the investors would be basically providing these people an incentive to be pretty particular, pretty careful in rating this bond. And they'd be very reluctant to give it a AAA or a AA rating if these people over here, the investors, are saying, you do a good job, or we're not going to do business with you in the future. But the way it works is, The borrower is the one that says, hey, I want you to rate this. Here's some money. And I don't think the words actually are said, but the implication is, hey, you do a good job, whatever that means. Hey, you do a good job. If you want me to keep doing business with you. Do you think it makes any difference who's paying them? Would it you? If you were running these companies, would it make a difference to you who you got your $50,000 from, whether it's the borrower or the lender? Maybe. That's one thing that people lately have been saying, over the last few years. There have been a lot of bonds kind of get in trouble and loans kind of get in trouble lately. They got high ratings from these agencies. And then people are going, hey, what's going on? What is going on? Is this all set up right? There's a lot of scrutiny that these agencies have come under recently because of this whole process. Anyway, we're just going to pretend like these are really reliable ratings without getting into the controversy any more than for me to just inform you of what's going on. Okay? So, let's draw two supply and demand diagrams. And we'll make them look exactly the same. Side by side. Yeah. We'll have an interest rate of 5%, quantity of credit, and there's a difference here, but we want it to be some difference. It's not a big deal. For example, these could be, I don't know, drugstores, and these could be department stores. Maybe grocery stores be a more similar comparison. And we say, oh, look, here's money and it's being loaned. And it could be loaned to these drugstore chains and so forth. It could be loaned to grocery store chains. They're both in the retail business. They're sort of serving similar customers in similar markets around the country. Not a big difference. When they borrow money, they're both paying about the same interest rate, let's say about 5%. Now, something could happen. There could be some new federal policy. Let's say that a federal policy comes along and it says this. The price of pharmaceutical drugs goes down 50% by law. Whatever you've been charging for drugs, you charge half as much now. Or else big fine, jail terms for the executives of the companies and so forth. And I'm just using a hypothetical. What I really want to do is I want to add some risk to, and it doesn't make any difference for the sake of our example, I want just to add some risk to one of these stories here, one side or the other. And so I made up a hypothetical example of we've got a new federal mandate says lower the price of drugs 50% because we want everybody to be able to afford drugs. Okay? So now what we've done is we've added risk, not physical risk to the building's going to fall down, it's risk, financial risk that we've added to these companies. These drugstore chains, now maybe they were earning whatever 10%, 20% profit to begin with, but now that this new federal mandate came along, financially, these companies are just not in the shape they were in before. And you know what they'll say when this law is being discussed? They will say, don't do this. It'll make some of us force us into bankruptcy. Right? I mean, isn't that exactly what we'll hear? If you pass that law, some of us can't make it. We're barely squeaking by as it is. So we've added some risk to our story. And whatever the ratings were before, maybe before the ratings were A under either one of these systems. But now what happens is the drugstore chains, they slip 1, 2, 3 notches on the credit rating. Right? Is this making sense to you? Now, let's talk about what this means. Put yourself in the place of a lender. You've got money to lend. Now, you as an individual, not as an investor, not as a lender, but you as an individual, you might like risk. You might like to ride motorcycles. You might like to skydive. Right? But you don't like your money to do that. Because that skydiving and motorcycle riding, that can be fun. You say whoopee and so forth. But when you've got this money, if you're just getting 5% either way, you don't really care about that money having fun and saying whoopee. What you're saying is, I'm getting 5% either way. I'd just as soon be more likely to get it back rather than less likely to get it back. I want to get it back. So what we're saying is that investors are risk averse. We have an aversion to risk. And if we have an aversion to risk, then we start looking at the situation and say, you know, I've got some bonds that were issued by some of these drugstore chains. I've got some bonds issued by these grocery store chains. I just don't like the way things are going here. I think I will avoid that risk. And so now what happens is the credit supplies start shifting. Supply of credit starts moving. Aversion, avoidance of risk. And so when we come back up here into this picture, we say, you know, I noticed the supply of credit avoiding the risk and going to where there's more safety. And then what happens is we find an interest rate differential. And maybe this rate goes up to 6.2%, and this rate goes down to 4.2%. What I don't want you to do is draw that where there's exactly the same percentage change with both. And so I didn't. This went up plus 120 basis points, and this one went down 80 basis points. Remember the basis point? 1/100th of 1% of interest. Better put a minus sign there. Okay. Why don't they change by the same amount? And the answer is because the elasticity of these curves will be different. They are, after all, different markets. Okay. So anyway, it's not an important part of the story that the interest rates change by the same amount. There's nothing to be assumed there. But what we have is this now. We have a differential, 6.2% minus 4.2%. Now we've got a 2% differential, interest rate differential, to compensate lenders for the extra risk. In drugstore loans. The demand for credit didn't change. The people who run drugstores still want to borrow. The people who run grocery stores still want to borrow. It's the suppliers of funds, and by the way, the same thing will be happening in the stock markets as well. But right now we're talking about in the loan market. The people who are supplying credit are averse to risk, and so they are moving their supply of credit. They're selling some bonds and they're buying other bonds. Okay? Questions about this? In theory, and all we can do, we're human, and all we can do is come to our best judgment. In theory, if there's a 2% differential arises now because of this risk aversion, then there will be enough additional defaults on these loans where that we lose 2% of our capital. But we got 2% extra return, and so we break even. We are being compensated for the risk we're taking. And that's the theory of it. We don't know that's the truth because what's going to happen is after the fact, somebody have to come along and look this situation over and say, hey, you got an extra 2% of interest for taking this risk, and you lost 2% due to defaults, so you broke even. But in theory, that's what happens is we just break even. And then if there's any more shift, the interest rate differential gets bigger. Let's say the defaults cause 2% loss of your capital, but maybe if there's more shifting, you would have a 3% interest differential. You'd be overcompensated for taking that risk. Yes, sir?
Now, credit card companies, when they assess your risk, use the credit score, right?
And it's the same idea, right?
Yeah. What happens if you have two credit cards, you default on one, your credit score goes down, how come the other one doesn't go up percentage-wise?
I didn't know it wouldn't.
It did for me.
It didn't for you, and you defaulted. I would say it's a matter of when they reprice that credit card. So you've got, but what I mean is when you borrow money from a credit card company, then there may be an agreement between you and that credit card company. Here's how long your interest rate is locked in. And then it may be that you've defaulted on one credit card and the other one doesn't have the right yet to reprice that loan. But they know that you've defaulted because that interest or that information's out there about you. And when it's time for them to reprice that loan, they will take into account that you defaulted on this other loan. Great. I got, what is the deal I have with the credit card company? They raised the price of my, or they raised the interest rate on it, and gosh, it was some low rate, and then they raised it to like 15% or something like this, thinking I guess I wouldn't notice. I call them up and I go, hey, what's the story with this? And they said, oh yeah, we did that to all of our customers. And I said, you know, there are people near and far that will loan me money at a lot better rate than that. And they said, oh, okay, and then we'll lower that for you. And I said, okay. And they said, where would you like us to lower that to? And I said, well, 0. Yeah, 0. And they said, well, we can't do that. And so they've got some flexible rate. And then they agreed to leave my rate at this lower level, which is in the 4% range, until the credit card expires, 2012. And so as far as I know, they're locked in. Now, that would be unless I default on my agreement with them. But as long as I keep up my deal with them and make the payments on time and stuff like that, then they are agreeing to loan me the money at this 4% whatever rate, 4.5%, until 2012. Okay, other questions about this? Stop defaulting on your credit card debt. It'll get you. Hey. Somebody's recording this stuff. I would never say a word like that. Okay, everybody with me on this deal? This is another term that economists use. I want to write it down. This is a compensating differential. In theory, we're exactly being compensated for the risk we take. There's going to be, in theory, 2% more defaults on the bonds issued by drugstores than grocery stores in our story here. And so then you get an extra 2% interest to compensate you for those losses. And then it wouldn't make sense to avoid risk anymore because you say, hey, I'm being paid for taking that risk. Any more stories about your default?
No.
I think you're going to default on more than that. Compensating differentials. By the way, the same story goes with respect to wages. Let's say that what you do is wash windows. Okay? And there's 2 different window washing jobs, and the one of them is you're standing on the first floor and you're washing windows. And the other one is you get up on one of these high-rise buildings, you know, on these platforms that go up there 15, 20 stories. Do you think those, they're both the same job, right? Washing windows. You think they get paid the same? Because you know if you're standing on the ground, there's not far to fall. If you go, oops, I had an extra beer at lunch, you fall 4 feet. And then you get up, dust yourself off, and go back to washing windows. If you're up on the 20th floor, there's, you know. So anyway, what do? And the answer is this, and I know it's a different story or a different picture, but we've got supply and demand for labor in that case. This would be like the jobs up on the 20th floor, washing windows. Here's on the ground floor. And then what happens is people go, nah, just as soon not. If they pay the same, let's say in both jobs we're paying $10 an hour to wash windows, then you say, no, I'm not going to wash windows on the 20th floor. They pay the same, I'll take this job. Supply of labor decreases, supply of labor increases, wages adjust, and now there is a pay differential to compensate you for that additional risk. Make sense? So this is really kind of a common analysis, but we're using it here to understand the interest rate differentials that arise. One thing that is important for creating these interest rate differentials is recessions. Recessions. And so let's just say this, that we look at a situation. I'm going to do a little erasing here and use the same graph. Let's say that we use a graph and we show an interest rate differential that exists. Maybe here's quantity of credit to the Treasury. We're loaning money to the Treasury Department, and maybe the interest rate is 4%. And we're lending money to, let's say, some corporations, supply and demand, and maybe the rate's 5%. And so there's a difference, quantity of credit to, I don't know, AA corporations. So we're in this situation to begin with, and due to the differential amount of risk just during normal times, there's, in this case, a 1% interest rate differential. Okay? And now let's move forward and we get into a recession. If there's a recession, what we start thinking is this. Recession, that's bad news. These people right here, the Treasury, they're going to be able to pay us back. How are they going to pay us back? They're going to borrow more money. But they will not default on their debt. Now, here are these corporations. Boy, AA rating, that's good. But a certain percent of these companies can get into financial trouble and maybe not be able to pay. And so at a time of recession, what would happen is this curve might shift to the left as to due to risk aversion. And these dollars start flowing again. And here's S2 to the Treasury. And now this interest rate goes up to, I don't know, 6%. This interest rate goes down to 3.5%. And so we started off with an interest rate differential of 1, and then it went to what, 2.5? So this is at a time of, let's say, economic expansion. And here's a time of a recession. And what we see is this differential, and we just call that a risk differential, widens. And guess what? Some people, in fact, watch this risk differential, just watch it over time and graph it over time, and it might be that here's the interest rate on AA bonds minus the interest rate on Treasury bonds. Maybe we'll take both of them as 10-year bonds. And then we watch this over time, and maybe it's just kind of floating along here a little bit more, a little bit less, and then it starts trending upward. And when it starts trending upward, some people say, hey, that's a sign of recession. What's happening at this point, when that differential starts rising, it means this is taking place. People are moving their money. What caused them to do that? Fear. Fear of what? Fear of recession. Now, here's the deal. I'm an economist. I can say to you, hey, a recession's on the way, or hey, the recession's over. And when I say that, I don't pay a penalty if I'm wrong. I can just say anything I want, and then 3 months later, I can say something different. No penalty. These people, when they start moving this money around, these are people that are managing sometimes billions and billions of dollars. Their jobs are on the line. They really care, and they are studying the heck out of this, and they care if they're wrong. And so this is a really sincere measure of whether the economy is likely to go into a recession or not. It's the people who have something big at stake that are saying, I'm moving these funds away from risk towards safety, and this is called a flight to safety. And they say, we're doing that because we see a recession on the horizon. Okay? That's it. Next time we'll talk about something else that gives rise to these interest rate differentials. So long.